that, and then we'll get started.
Hey, Robert.
What's up, Gavin?
Hey, Jimmy. I actually
time zones are tricky.
got my
Gavin.
time zones.
Time zones are tricky.
Wrong time zones are hard sometimes.
Welcome everybody to another episode.
I have a 3 o'clock, so I can be here for a little bit.
December 7th of 2022.
Time zones are tricky.
Been fighting the flu for about 5 days, and
welcome
kind of on the mend. But I'd say I'm
probably,
as I said last night,
this week it is December 7th, 2022.
Apologize for any.
I have been fighting the flu for about 5 days, and kind of on the mend, but I'd say I'm probably, as I said last night, about 70%. So apologize for the voice, apologize for any sniffles, and yeah. So, but with that, we're gonna dive into it. We've got a couple of awesome guests here, my boys Gavin and Jimmy, and the one, the only Mike T, who's tuning in and gonna kind of jump up here in a few minutes. He's down in Florida at the racetrack with his son. So, but where this is the weekly notebook review. For those that are new to this session, we're kind of what we do is we assess kind of how signals and how things have shifted, or kind of what's jumping off the page for us from the weekend work into midweek, and as we head into the back half of this week and kind of next week, this month, next quarter, et cetera, et cetera. So just kind of trying to really get a good feel for kind of some things that are pivoting, some things that are shifting. As Gavin noted this morning on Twitter, he commented about the VIX opening in the top half of its risk range for the first time since, I believe it was October 13th, right? 13th or 14th, Gavin?
Yeah, that's what I had seen this morning. And so, no, go ahead.
No. That's awesome. Yeah, no, it was a great call out and something to definitely be paying attention to. The other thing too on that was, it was, I'm sure everybody noticed, or if you didn't, you should have. It was a higher low on that low end of the risk range on the VIX too, right at 1908. Now that's still kind of right is at the trend level, but not only is it kind of putting in, or was it opening up at the top half of the risk range, but the low end of the risk range, putting a higher low for the first time in quite a while. I don't have how long that was off the top of my head, but it was definitely something of note. A couple other things in the notebook today. The oil definitely just keeps falling out of the bed, and really just is in complete collapse mode. So this is something that's interesting here in terms of oil, and then again one of the weaker FX. FX or currencies in the FX space would be the Canadian dollar. That continues to kind of put in weaker signals from a risk range standpoint, and really has been kind of acting completely differently than, say, the other three that we track on a regular basis in terms of the euro, the Japanese yen, and the British pound. So just definitely wanted to kind of call out those things, and obviously the Canadian dollar and oil have a bit of relations there in terms of what's just in terms of correlation and stuff like that. You can tell my head's a little foggy here, boys and girls. But with that, maybe I'll pass the puck over to Gavin and kind of get things and see how he's doing. Hopefully, he's got a little bit of a better handle in terms of communication. this
I feel for you, man. I know. My girlfriend had a 10-day thing with this flu. I kind of skipped over it. I think I just eat too many sardines, and the sardine oil in my blood just kind of, it fends off like everything. But no, man, it's tough. I know a lot of people who have just gotten this thing. And it's for her, it was like a 10-day cough. It was like this coughing, and I don't know what it really was. I don't know if we really know, but I hope you feel better, man. But just rest up.
Thanks, man.
Look, I'm on the scent the last few days, and for me, it's like I'm either 100% confident or 100% unsure. And the only thing that will get me off the scent is a closing price after everything calculates, and I'll say I'm wrong, but I think I'm right. And so it's been November was tough. I started back in on the dollar late October, and I'll say I'm still a dollar bull. It's not my biggest position anymore. I still own it, but we'll just see. My sense is like this is a spot where dollar bulls will start to capitulate, and I'm not ready to do that with what I see. So yeah, I'm just kind of hanging in there. I'll say in terms of Hedgeye, like it's been great. The call on we've not really owned stocks a lot through the year, and I really had to think long and hard before owning any stocks because I don't like the risk reward at all in that asset class. But we are long some healthcare and staples, but we're not long short all the time. But we do have it paired off with the mega caps, which has been good. I know you've been talking about that, Robert. That's been a good way to do it. And for us, it's like everything is against or in comparison to what you could get on, short-term T-bills, to justify taking the risk. And I just kind of, went through and crunched the numbers. And I said, I think if we do, some of these spreads on these long short ideas from Hedgeye, like, healthcare has been good. Mike T's on here. The pink ETF has obviously been doing well. I don't know if I'm supposed to say that. Sorry. Anyway, long short has been working out pretty well. And I think it will continue to. So I know a lot of people have considered, getting long stocks, and I'm just not there yet. Just to get long without something against it. So what else? Bonds, right? When's the last time you saw Keith's 10-year risk range going bearish? It's a long time. So that ought to tell you something. It doesn't matter what everything else is doing. It's just like, look at how long that's been. So take note. It doesn't mean to come in and just chase long duration here after it's run for a few weeks since mid-November. But just take note of it, and I think watch it and see what's going to happen. Does it become investable into Q1? Certainly, a lot of people hope it does. So you have your eye on that. And then go ahead.
Just along those lines, I think it's important because over the last month, basically, the 10 years has gone from to 4 spot. Was it 4 spot? Basically 4.10, call it, down to 3.435 today, right? So I mean, it's a pretty huge move in the last month, and it's a pretty classic scenario where folks definitely kind of want to end up almost chasing it at the top end, or in this case, the low end of the risk range. But don't be, don't do that, first of all, and secondly, don't be surprised if this thing, if the that risk range is sitting right at the trade line, the top end of the risk range, right? So I think that's a really, really interesting component, and something that Keith has called out over the last week in terms of like how the width of the risk range and how it was actually above the trade. So today was the first time, I believe, where it kind of landed almost right on the risk, right on that trade line. So don't think for a second that it doesn't have the capabilities, just from a pure math standpoint, of slicing basically right through trend, which is now resistance, going right up back up to the trade line, and that obviously is now resistance as well. But don't be shocked to see that happen. But then also be prepared, right? Be prepared, because if the signal continues to act as it has over the last week or week plus, then you're going to want to be there to fade the emotions, fade your feelings, fade the market in terms of that was a head fake, and potentially put on that long bond trade, that TLT trade, when nobody really wants it anymore. So just wanted to highlight that, Gavin. Just good call out.
Yeah, for sure. You can sense that people want to chase it, but here we are going into another year, and we'll see. Yeah, so I think it's interesting thinking about the oil signal. I think, as I'd been pretty vocal, like there was a couple months there where it was kind of flip flopping around, and I didn't have a really clean read on it. I know Keith was back and forth on it. And I'm watching his signal, and but then over the recent weeks, it's really kind of just definitively. You just see it getting hit, and it's interesting. Like on a very zoomed out look, like when you're looking at energy, you're looking at bonds, you're looking at stocks and currencies. Closing the month of December, we're like, there's this potential for everything is like pushing on what I would consider like really key levels for like a very long term view. So, like this breakdown in oil is quite interesting, I think. So, yeah, it's definitely not a long anymore, in my opinion. I know some people have been kind of pinging me, or I've seen the question kind of out there, like, well, maybe if you're like a mean reversion trader and you want to just play a bounce or something, but that's not what I do. So,
I mean, I almost just I almost spat out my hot water all over my keyboard when you said it's definitely not long anymore yet.
yes, yeah, right. So,
yeah, that's pretty clear. That's bearish trend.
right.
I mean, just the risk range alone today, Gavin. I mean, you see that it was a massive lower low to massive lower high.
Yeah,
Like just
I
like
have it.
it was epic. And that's happened multiple times in the last few days. I mean, on Monday as well. I mean, it's been putting in like lower lows and lower highs consistently. But I mean, it was a huge move this morning.
Yeah, and energy stocks too. I mean, it's still what I liked about it. Potentially as like as a short is because everyone loves it so much, and everyone's been in there, and it's so easy to see in the numbers that it's been identifiable as the best place to be. And so I'm not saying I'm like, just tactically, it was an interesting spot when you saw it breaking down there, and then what oil's doing. So yeah, I mean, it's it's interesting in energy right now. I don't have much other than those kind of
Yeah, you have.
fallouts.
I know you pay pretty close attention to the FX side of things. Anything standing out there? I mean, it's to me, kind of the pound, yen, and euro are kind of in like consolidation mode in a bearish, in their respective bearish and slash bullish for the Japanese yen, trends, but are kind of like counter trade at the moment,
Yeah,
or have been
yeah.
making counter trade moves in their. You get the point.
Yeah. They were right in line with the whole trade, like with the dollar yen, or not.
Yeah.
Yen was a little late, with obviously dollar euro, and then stocks was all counter trend together. Bonds came into the party late, which was
Mm-hmm.
interesting, like a few
Mm-hmm.
weeks. And so yeah, I had talked to or tweeted Chris about it, and
Mm-hmm.
still, like, I just went back to my notes from this weekend, and it's the Swiss franc is what is. I don't know what is going on there, but I've just noticed some strength relative to
Mm-hmm.
the other currencies. So I don't know. I see what I see. So
Yep.
there's that one, but yeah, I mean, we're when I pull forward everything and look at where we could be and kind of game it out, we're thinking about PPI and CPI as calendar catalysts just to move the market in either direction. We're at an interesting spot going into Friday's PPI. So, I could see I could see the counter trend move wrapping up, in my opinion, Friday, or it could get slam the other way and continue. But we're kind of sitting, I think, at kind of interesting levels. So,
Yeah. Great. Awesome. Well, appreciate that, Gavin. Jimmy.
Good morning, good afternoon, Robert. I hope you're feeling a
Morning.
little bit better.
Yeah, thanks,
I
buddy.
too have been dealing with a sick daughter the last couple days, so it's the sample size is growing. I think
Yeah,
Keith was talking to Jim Rickards about anecdotes this morning, and we're building a little sample set ahead of this winter season. But wishing you a speedy recovery.
thanks, buddy.
I got a three-parter for you guys today. So I want to start off with just expressing some gratitude for the Hedgeye community this year. We're in December, so this is a chance for me to reflect on some of the things I've learned, as well as just how this platform and this community has really evolved, right, in the last 12 months. There's this funny thing about being anonymous on Twitter versus being, doxxed, if you will. And what I think drew a lot of us to both Twitter as well as this community is that um, rather than the intellectual pontification, the popularity contests of fin tweet celebrities and people who host spaces, this has always been about ideas, observations, and action. So, um, you know, don't listen to don't listen to what I'm shilling. Don't listen to what Mike Taylor is showing. We have a lot of great ideas, but ultimately, it's up to us to do our own research, to be at peace with our own limits, and generally not to violate our rules, but also to know the meta rule of when to violate them. I'll just share very briefly some of the things I learned this year. I've had some catastrophic drawdowns in my small cap portfolio, which started last year. And it kind of reminds me of this funny thing, when I see Tiger down 54% year to date, my buddy who ran Hayden Capital with his positions in C, Coinbase, and Carvana getting liquidated today, down over 80%. The idea that when liquidity gets tight, we're looking longer term couldn't be further from the truth, right? I've learned this year, in both good and bad, that preservation of capital in a bear market is key. This has been humbling, no doubt. I've also learned that it's better to be a little bit late than a little early. When we're a little late, we're watching the data. When we're a little early, we're hoping for something, and we get a little emotional. I loved what Keith has said in the past about when we're sizing appropriately, we get a chance to kiss our positions more if we like it, right? We're not hodling, we're not all in, we're staying sharp, we're trimming so we can buy, so we can stay active, so we can see. And I encourage us, especially as we go through the next 3 to 6 months, trying to find the inflection point, trying to find the bottom. There's going to be lots of false starts. So I think I'll just end it with a bunch of these risk range call outs. I think that's a great way to kind of talk about the space. We have the week over week, we have the 1 month, but in particular, when the markets were ramping up after Powell just a week ago, last Wednesday, right? I'm looking at the risk ranges from December 1st. So that's Thursday that incorporates Wednesday close. And by and large, if you look at it, not a lot of things have changed. We went from the top end of the range in some to the bottom end. Apple, basically 138 to 150. It was at 148. Now it's at 140. Um, you know, Even Bitcoin still kind of consolidating. Tesla, almost the same, except we're at 194 to 175. Um, Natural gas, oil have collapsed. I'm looking at XLV, higher highs, higher lows, which I like. I'm looking at, even if you look at, let's say, XLK tech, we have this huge complacency, you know, I've all, discounts, but the range has been the same. And now we're just at the bottom of the range. So I do think it was interesting that Keith covered some of the shorts. Right, we're going to be patient here. The bottom's not falling out right now. Even the VIX, today compared to December 1st, it's still tightening. We're a little higher, on the lower end and on the higher end, but we're still in this zone. But I'm very interested in that. I think the two call outs I have in terms of additions, ITA has been kind of a favorite for many times throughout the year. Re-added, and today, it's moved up a little bit, but the range is 109 to 114. It's at 111, so on a relative basis, you're kind of getting in below the midpoint. Last week we talked about XLU, how I thought that was the most interesting one because it's rate sensitive, it's got the factor exposures, but we weren't sold. The bonds, the 10-year hadn't broken down and showed, bearish trade on yield. So that was the one to watch. And, lo and behold, today, Keith said he has a lot of similar factor exposures, but I like that one today. It's, towards the top end of the range.
You've been on a bit of a heater the last few weeks. You called out healthcare before it went on. You called out Utes. You've been pretty solid there, Jimmy.
Thanks, man. I know I'm rambling a little bit with this, some of these risk ranges, but there's a lot to talk about, right? People want to talk about the Dixie, VIX, China, crypto, energy, yields. So let's have it.
I've been sensing that too, Robert. Like, when if you're watching a guy, like, when someone's hot, and that's a thing in this pursuit, right? Like, you go hot and cold, and I've sensed that, Jimmy. Like, I've seen some of your tweets here and there. I don't get on here as much as I would want to cruise around, but my sense is that you've had the hot hand. So
I was higher 2 days ago before the MSOS balloon deflated a little bit. Now I'm a little sober.
MSOS, yeah.
That's a squirrel.
Hey, yeah.
Yeah. I think it probably is a little bit more squirrely than a squirrel. So what's that? I'm not sure what would that. I'm not even sure what that would be. Maybe a mongoose. But all right. Well, I know Mike T. You've been listening in. I mean, if you can jump up, I'm happy to invite you up. But would love to kind of get your, if you can, love to get your kind of thoughts on what's transpiring, what's on your hit list here as we're a couple weekend into December. How are you, buddy?
Hey, can you hear me okay on these headphones?
We can. Yeah, everything's good.
Good.
Mike.
I'm glad. I'm
welcome.
Believe it or not, in a surprise move, I'm at the Homestead Miami Speedway racing. So of course I am. So I apologize if you hear some cars raging by. I'm in the truck right now. Hopefully it's quiet.
It is. It's great. So no, thanks for tuning in. I appreciate it, buddy.
Good. MSOS, just because you brought it up. There's like 100,000 calls on a spread all the way up to $30 a share. It's at 11 right now, approximately. And in the event that this SAFE Act gets through, either in the defense bill or the omnibus, I have a number of guys in DC that I've been close to for 20 years, and so I have some insight as to the process and ongoing. I personally actually think it's a very high probability the SAFE Act gets through in the lame duck session, and in the event that this rips, retail's just going to take this to Neverland, very likely in short-term calls, and they'll just basically YOLO it up to the moon. And the reason why it's very interesting is all the calls that are out there. That the market makers are totally not hedged for this. And they're going to be forced to come out there and buy millions of shares as it goes up in order to hedge against their calls that they sold. So just FYI, we can have something really stupid happen in the next month. So I have a position on. It's let's see, it's in options, and it's probably about 2% of my book. On the long side, and what happened here, who's involved is retail, and so they really don't know what's going on, and so they're very panicky to sell, panicky to buy, and it's just going to be headline after headline. I think today for a trade, and it is a YOLO stupid bigger fool trade. I think it's a long today. So that's my view on MSOS, and I bring that up because you guys brought it up.
I love that, MT.
Yeah.
I've got 30 calls and 45 calls.
Yeah, so you're the guy. I'm going to tell you
I
how
am the guy.
did
You
it.
got to watch out for me.
I'm on the 12 line. I paid today $100.60 for the call, so I'm long between 13.50 and 14 on it, and that's how I'm set up. And I got about 2% of my book there, and it's a really functional big deal for these pot stocks, And these pot stocks have really consolidated a lot, meaning that businesses have gotten a little bit smarter, and we're probably not going to see the wild negative pricing power that they had in marijuana, and so we're actually going to get some stability in their business. And with the SAFE Act coming through, vanilla guys can own it. They can't own it right now, and so it's not part of the benchmark. They don't own it, and they won't own it until they have to. And when they have to, as soon as when this comes out, and I mean, this is just one of those painful, rare events. It's kind of like Tesla when it got added to the S&P 500. Nobody owned it, meaning big money didn't own any, and it's a mega cap, and they all had to own some. Stock doubled, and that was a mega cap stock doubling. So here you have something that's terribly illiquid, and everyone is going to have to be there if this gets through. So I definitely see one where the fundamentals are okay, but you have this setup structurally on a thin stuff. You're trying to stick a camel through the eye of a needle. That's what I'll say. And I look for these situations, kind of like Mirati today. And Mirati MRTX does not appear in pink, and this is why. Today they have a drug that is a new mechanism for cancer, and I think that they have a dosing problem. And today you learn that they do have a dosing problem, and it's down 50%. And I think there's quite a bit more downside because the benchmarkers are already there. They're there for a takeout, and it's probably not going to happen. In fact, I think that their drug is potentially commercial zero. So this is part of the way how I try to protect our investors in pink by not having a position in a name like that. But again, that's the camel going through the eye of a needle. And there's, meaning all the vanillas and many of the hedge funds have to get out because the thesis is broken and you just can't get there. So there's a few things I want to talk to. I just got off the phone with Keith. He was between calls on with some big vanilla gigantic shops, and this shutdown of gating of the Blackstone products, 2 of them now. These are monster products that private wealth has jammed their clients into, and now they're gated. You can't get out. And I was talking to Keith about the canary in the coal mine, and how in 2006 there were 2 real estate funds that they owned MBS, and they essentially went bankrupt in 2006. And Bear Stearns had to bail out their balance sheet because Bear Stearns was a sponsor or the prime to these. I think there were 2 internal funds, and that was a canary in a coal mine in 06 for what was going to come. This isn't a canary. What has just happened at Blackstone is a pterodactyl, and not in a coal mine, but in your bathroom with you sitting at the throne. This is bad. This is really bad because it means that you can't get your money out, and what they're going to do is turn around and reach for liquidity everywhere else, and everywhere else has even less liquidity, meaning in these illiquid wealth products. And so they're going to get gated in the 1Q, if not sooner, and we'll have those announcements coming. And that's super duper bad for debt, bad for stocks, bad for just bad. This is how crises happen, especially in the illiquid debt markets. Couple that with the markdowns that are going to happen in privates in January. The auditors are not going to allow these fake markups to get through on the filings in December. So we're going to see privates marked down. We're going to see a liquidity issue, and I think we're going to see a lot of people going for the doorway that's going to be locked shut, and I think it's going to ramp. So I'm very worried about that. And I believe it or not, I'm not set up for it. I'm set up for a dovish CPI and one last final good squeeze. And this is what I discussed with Keith about. Well, I have an idea of what's going to happen, bad, but I'm not positioned that way because I want to make money more than I want to be right in the near term. Does anyone have any commentary, any questions? And I have an awful lot that we can talk about, more so, of course. But I just love, because you guys always have some unbelievably smart questions to ask about what I'm thinking, what's going on with the tape. Oh, by the way, I hate this tape. Everyone's getting freaking drilled. Nobody's making money. Very, very, very painful. And we also have redemptions that have started with the larger hedge funds.
Hey, Mike, I got a question for you. There's a popular macro narrative that says if bonds catch a bid into year end and yields decline, it's going to be harder for stocks to puke from here. And whether it's the Santa rally, whether it's the year end markups, whatever, what have you, do you see any resemblance of that? Do you think that's something that has any historical backtesting?
In fact, it is a complete false narrative. If you look back at the correlation between interest rates and, say, housing stocks, go back to 2000s, go back to 06, 7, 8, 9. There isn't. We just are having this bizarre correlation right now between housing related stocks and interest rates kind of working in tandem. And I just think it's a narrative that's going to break down. It'll probably break down probably the next set of numbers, because they're kind of like Lowe's and the others. They don't understand what's coming or what's already here. And I know an awful lot of contractors throughout the country, and their business, like flat out, all of them are down 50% plus year on year, or 50% plus from where they thought it should be. And they're laying off and not doing projects. They're filling out their backlog right now, and they have nothing on the come after it's done. So Lowe's, Floor and Decor, all these guys are going to see this immediately, probably just now. These guys, you have to remember, all these retail outlets, they literally have 2 weeks of visibility. That's it. And they're guiding for the year. They have no idea what it's going to be. They're just kidding themselves. And you know how it is. Whatever they say, that's what the sell side does with a little upside, because they always want to, look, they want management to go to their conferences. So they basically pat them all on the back. I mean, a case in point, Carvana, right? What a steaming pile of crap. And you got guys now downgrading it to sell. You're like, whoa, take that victory lap, buddy. You totally nailed it. From 8 to 0, while you have a buy from 400 to 8, So it's just, this is what happens. They don't have visibility. They don't see it. The sell side is not your friend. And somebody asked a really, really potent question and point on Twitter that I hadn't thought about. And they asked, and you guys might have seen this, they asked, how do you do this if you don't have a network of people inside of the business that you can talk to and bounce things off of? And I mean, that successful group of people. And I was thinking, my God, how could anybody do it well? How could you even remotely do it well? I mean, I was thinking Hedgeye is an incredible resource on getting a lot of it right. But so far as the setup and how hedge funds are positioned for the moment, and looking at the options exposure and looking at the yen and how that's moving, and most people just can't follow all of that stuff at the same time. And look, they have a day job, right? People work for a living. There's very few people that just sit at the screens all day and trade profitably. I mean, it's one out of a zillion. So that was a really, and all I could say is it really helps to have an incredible network of brilliant people that you can call and talk to all the time. I'd be hard pressed to put up the numbers that I have without my network. I mean, I'm certain I couldn't. I could not. How could I have insight on this MSOS thing? Stuff like that.
No, it's a fabulous point.
Yeah,
it's a great point.
So basically,
it does take a village.
I have a 2% position on that could deliver to me a 8 or 9% return on the book, and that's with a probability that's pretty high, and I don't know. So God, I feel for the people that are young and trying to do this on their own, and there's millions of them. I mean, we have so many new retail investors globally and that's not going to change. The friction has been eliminated. From signing up an account and get trading. What I do fear is that most of them are going to get cleaned out because they don't have a process. It's all YOLO, and boy, are they going to exit with a very, very sour taste in their mouth. And well, I guess it's much more accommodating though with the sour taste when mom is still cooking you dinner because you're now living in her basement. So I guess it's not that bad. So.
Hey, Mike,
Gavin, you had a question,
yeah. Yeah. Just rewinding back to thinking about like gaming it out. Okay, CPI comes in light.
Who the fuck knows?
Yeah, but so if we're gonna have like a risk on flavor into the end of the year, my question, I guess, because I have a sense of what I think, but do stocks or does the long bond go up more on that trade? My sense right now is that the long bond wants to go up faster than stocks, but
yeah. Well,
I don't know.
I'll say
What
this
do you
to
think?
our listeners is that I think on the last time I was on Hedgeye, and I've been pretty vocal about it, that the only thing to own is the long bond. And I apologize. I was like a month early. So this was like 2 months ago. And I lost probably about 3 or 4% of my options trade for it. But now it worked, right? So like a month later, now it worked. The long bond is my biggest position because I have no idea where people are going to put their money but there. And then it started to play out because I think we're going to have disastrous economic situation. I think because of the comps, the inflation is going to collapse March, April, May, and then it'll come back because again, the comps. So you just really have this comping situation where we have this kind of blow off top in March, April, May, and we're going to comp through it, and it's going to comp through it for many things will be negative. And so that'll make the core CPI look pretty good, and the overall CPI will look good. And everyone can say, oh, the Fed's going to pivot, but the Fed's not stupid. They know that they're not going to pivot, and they're basically going to hold this all the way through because inflation is just because of comps going to come back. And they know that if they pivot too early, and I hope they don't pivot too early. And I don't mean it for my book and my trades. I mean it for the country, because we're at a spot right now on the 1 to 3, 4 year that the government is essentially funding itself right now at 2x plus the yield that it normally finances itself. And we're paying about 15% in coupons out of the federal budget. It'll go to, if we hold like this for 3 years, it's going to go to 30%. And that means that we can't have a military. That means that we're going to have Social Security cuts, Medicare cuts, everything cut. It means super duper bad things, crazy bad things that will happen if the Fed pivots too soon and allows inflation to come right back. And so my view has been they are going to have to crater the economy and only turn to pivot when inflation is way down because jobless claims are way up. And I don't think that can happen at least until the end of next year. And the street is absolutely not prepared for that. They're prepared for a Fed to pivot as soon as clouds appear on the horizon. And if they do, inflation will come raging back very quickly because we have a scarce resource situation that's really not going to improve in the near-term years. And so they're in a real pickle. If they pivot too soon, Mike, we're screwed, really screwed. Meaning the Treasury is screwed, bad, super bad. And then I'm distinctly worried about those outcomes because then we're looking at the Fed will have to then hike again and really, really, really crater the economy. And so we'll have what they'll call, a double dip recession. Now I'm talking about back half 23 will be fine. It'll be a rip-roaring rally if they pivot, blah, blah, blah. But when you get into 24, we're going to have inflation come raging back, and they're just going to have to slam on the brakes again like a disaster. And now we'll be 2 years going into 3 years of the Fed placing treasuries at 4%, 4+% on the short end. And boom, that's it. Remember that like 75% plus of the entire federal debt is on sub 4-year paper. So we cannot have yields at 4 to 5% for 3 years, or else the federal government's going to freaking blow the hell up. And that's my biggest fear.
Yeah, I mean, elevated for longer, right? I mean, that's right in the Hedgeye wheelhouse, right? In terms of Fed not pivoting, having it be stickier for longer, throughout basically into the back half of 23 and really likely all the way into Q4. So it'll be interesting. I'm with you there in terms of the street certainly is not expecting.
So
that.
Here's the setup. The setup is we're on the cusp, in my view, of a meaningful downturn in consumption. The lower end credit has maxed out their cards. So we have that problem that's coming right now, going December and then January. We should see them hit a wall. And that's when things go bad. What also is going to make it super duper stupid bad is that the Biden plan to nullify the debt on student loans is probably going to get dinged by the Supreme Court, because while he's following the letter of the law, it is not the intent of the law. Forgive the loans right before the election so it wouldn't get dinged that there wouldn't be enough time to take it to court and have it go to the Supreme Court. It's all been a game to get votes. They're just a bunch of liars. And you can quote me on that. So I don't care. And so what's going to happen then, if you noticed, this time when Biden White House extended the you don't have to pay your school debts thing, which is 40 million people paying $300 or so a month, that's gigantic drag if they had to pay it. He qualified it this time and saying, well, we're going to push it all the way out to June. And the only reason we're doing that because we want a result on what the Supreme Court says. So it's no longer about COVID, because before it was an emergency around COVID, and that's why he was doing it. That's gone now, meaning the death rate, the severity, the economic calamity of it is gone. And so now it's just, well, we want to eliminate these loans altogether, and so we're gonna keep this going until the Supreme Court rules. Well, they're going to rule in the spring, and it's probably going to be around April. They're going to rule. They're going to ding it. And June comes, and really the White House no longer has a leg to stand on as to why they've kept this going. As you might recall, the reason why they can do this is under emergency powers that were granted them under a sort of calamity. And a calamity is whatever the White House thinks it is. So it could be, oh, it's cold weather, I have a bunion on my foot, or COVID. And that's the problem with the letter of the law. That's what it says, but the intent of the law was not this. And so even this, pushing this off indefinitely, could end up at the Supreme Court, and they're going to ding that too. So these student loans, in my view, are absolutely going to come back in June, at the end of June. And so we're going to have economic difficulty, consumption problems, credit problems, liquidity problems, and debt. All the while we have $90 billion a month of quantitative tightening. And then people have to start paying this debt that has been accruing on the balance sheet, their balance sheet, for the past 2.5 years. So I'm very, very worried. And this will get the Fed what it wants. It will get a total economic mess, and then they can pivot. But probably won't, like jobless claims probably won't get to 5.5%, 6%. until we're like into 24. And then maybe they can pivot. That's how I think it may play out. I hope it plays out that way because it's actually better for the long-term survival of our treasury and our debt situation. But either way, I'll trade it, right? Because just how I think it should happen, how I want it to happen for the betterment of the world, that doesn't mean it's actually going to happen that way. So I'm going to try to make money rather than being right, and I will be flexible. And if the Fed pivots, we're going to have a crazy rip-roaring riot of a market with inflation turning around very quickly to go vertical. And everyone will say, see, you can have stocks go up and inflation go up. And then about, by year end, we'll be in a disaster again, where it becomes extremely obvious the Fed has to turn around and hike again. And then it's a calamity. That was a long answer to your question. I hope that I covered it.
That was awesome. Yeah. No, like way more than I had hoped. So thanks.
Yeah, and I invited Reet Rob up here. Just
oh my God, Reet Rob. Reet Rob.
Yeah,
Hey guys,
what's going on, Rob?
I swear to God, Reet Rob has earned the little baby Jesus halo. He really has. Because
I love that.
Even if you're wrong about MPW, and I don't mean wrong, I mean wrong on the trade, you basically totally nailed a bunch of thugs that are running a shakedown, pay me operation. In fact, it reminds me so much of the developers in China, where they all knew this was going to blow up. They all knew it was just a matter of time. So what they did was just gut all of their companies and all the working capital out of it, dividend it to themselves, make loans to themselves, and get it all out of the country, and then it blows up. And that reminds me of exactly what MPW is. And I put this out the other day about Stored on MPW, and that I believe, as I look at this, is that Stored is actually been using those construction loans that they received to put up a hospital or hospitals. They've been using those loans as operating capital in the company, and they haven't actually spent it on building hospitals. So that's not legal to take a loan out like that and use it for something else. So I think they're lying about it, and that's why they haven't filed their financials. Because either they have to cook it and lie, which means somebody could go to jail, or they come clean and then show in their financials that they're actually using this loan for operation. And that's why they haven't filed their financials, because they're like, okay, it's over now. That's it. It's over. We all got paid. We paid ourselves a shit ton. Okay, let's just go bankrupt now and start it over. Redo. Well, and they don't care. Well, Mike, they don't own any of the stock in this crap. They've basically paid themselves out incredibly handsomely in cash and loans to their buddies over the years. So, and I actually even imagine that there's a meaningful kickback mechanism on the actual construction of these hospitals. So the rabbit hole is extremely deep. And anyway, Rob, you did it. You nailed it. You opened my eyes up to it, and I looked more closely, and I said, sweet Jesus, this is a fraud.
Yeah. Oh, good. Can you guys hear me, by the way? I'm not sure if I'm coming through.
Loud and clear.
Loud and clear, cool.
Oh, one more thing on Pink.
Sure.
I'm not allowed to talk about my returns versus the benchmark on Pink. I'm not allowed to market that. I'm not allowed to talk about that on these calls. So I'm like completely the opposite of Kathy Wood. Somehow she can just talk about anything how she wants, and our compliance is like, okay. But you guys can, even on this call, look at the MSCI healthcare benchmark and compare that to Pink over the past year, and you could even shout out what the basis point difference is in the performance of that fund versus the benchmark. Or you could look at the past year and look at the performance of Pink versus every other actively managed healthcare ETF and call out those numbers. And I'm not allowed to say what they are, but you can.
I love it. And Rob, yeah, you can get an MPW, but also I don't think you were on when Mike had mentioned that the Blackstone, the B REIT,
Oh yeah,
closing its gate as a huge canary in the coal mine. He was talking to Keith earlier on the phone, and so that was although I do love talking about MPW, that was really kind of the reason why I bro. Well, one of many reasons why I invited you up to speak was to kind
sure.
of, I know you talked about it on the call today, but would love to get your assessment as well, because it is a huge canary in the coal mine in
Y-
terms of what's happening at Blackstone there.
Yeah, sure. So
It freaks the
just full
crap out of me that nobody's talking about it.
yeah.
Nobody.
So
And it wasn't something that was like on Keith's radar. This is why I heard he started talking about it today. And that's probably because he and I talked about it last night at 10. And of course, he had to get up at like 5, and I felt so bad. You know? So,
Yeah, it was.
and
so
you guys know me. I only get out of bed. First of all, when I hear that there's $10 million for me to make, okay, I'll get out of bed. And then my son says, Dad, we got to go race. Come on. And that's it. And that's how I get out of bed. So I feel bad for Keith. Dude, talk about stamina. My God, that man. Just that
All right,
alone.
so Mike, let's let Rob give his 2 cents here. 1 second, man.
so yeah. So just by way of background, I just full disclosure too. I don't cover Blackstone, so let me just put that out there. But over the summer, a client of mine, guy who's like
Are
really
you there,
smart.
Rob?
Yeah, I'm here. Can you hear me, Mike?
Yeah, we can hear him.
Mm-hmm.
We can
Yeah,
hear
we
you.
wanted. I thought Rob was gonna talk because I
Yeah,
want to
we can
hear
hear
more
Rob. Yeah.
about this. Oh, I can't hear him.
I think Michael's rugged.
Yeah, well, just tell
Rob
Michael.
is muted. Rob might be talking, but he is muted.
No, we can hear him, Michael.
Oh, I'm sorry. It says on mine it's muted. Apologies.
It's all good. So should I go or should I wait? It's up to you guys, obviously. Go. Okay, sure, I'll go. Okay, so over the summer, a buddy of mine, guy I've known for a long time, we actually sat down in NAREIT, and he said, like, we talked about B REIT specifically, and I kind of dug into it, but not nearly as deeply as like I should have, or probably as deeply as Mike had. But essentially, like the problem here is twofold. There are triggers in the fund documents, similar to any like closed-end fund or any private, real estate private equity fund, where in this case, if the net redemptions, so think like the amount of redemptions less the subscriptions in any quarter exceeds 5% of the NAV, the company on a forward basis, the sponsor, so Blackstone, can gate the fund for the following quarter. So that's like problem number one. And it became pretty clear that like for an illiquid asset class, people were going to, at the very least, stop subscribing at the same rate and probably redeem some of their money. Now, the second thing that's problematic here is that the NAV concept is not necessarily market related. There's lots of discretion. So over the summer, as the REIT world was falling 20, 30%, et cetera, Blackstone was showing B REIT's NAV up like 8, 9% quarter over quarter and year over year, depending on like which period you were looking at, which kind of didn't make any sense. And I think, and I'm pretty sure Mike would agree with me, I don't want to put words in his mouth, that was quite deliberate, because if they took a true mark on, like, for example, their resi portfolio, of which they had a lot, it would have immediately tripped the gate. And so they probably kicked the can as far as they could before their valuation specialists and their auditors said, like, look, you gotta make like a more realistic mark here. Otherwise, like, we're not going to sign off on this. So that's the first thing. And the thing that I'm focusing on is, what does that mean for the REIT space? And in my opinion, it has the most negative implications for resi, resi especially. So like, and Sunbelt resi, because if you remember, B REIT last year bought APTS, BRG, and a couple of private portfolios focused on the Sunbelt, and in many cases, they were the only guys to like really, in a good faith effort and in a real way, show up at the auction. So if you take out this big pool of capital and make the market all a little more liquid on the margin, cap rates have to expand. That's really negative for Sunbelt resi and Sunbelt apartments. So that's something that I'm looking at. And then lastly, on MPW, just to put a punctuation mark on it, and I don't want to hog time, dovetailing off what Mike said, I would encourage people to look at the the case of the Texarkana development that we highlighted. So this is the one where I hired the photographer to to go out to this development site, which at least theoretically should be managed by MPW. But they sent 30% of the construction budget to Steward in late 2021. I think it was the fourth quarter of 2021, and in my opinion, have since misrepresented what was really going on there. Meanwhile, it's basically like a field, right? Like there's no work, there's no foundation, there are no improvements, and we're talking about 1/3 of the construction budget. There should at least be something going on there. And as a matter of fact, the site clearing work, the guys that did the site clearing work filed mechanics liens against Steward for amounts that totaled something like, $1.5 million. So really like nominal amounts that Steward did not pay. So
Rob, just so
really,
that everybody's aware on this space, can you elaborate on mechanics lien? I'm aware, I'm in real estate, but
yeah,
just
sure.
for everybody's sake, yeah.
Yeah, sure. So like imagine you're a vendor and a project manager or real estate owner hires you to, and I'm going to simplify it just so like everyone understands, hires you to perform a job and obviously invoices you for that work. So in this case, there was a company that was charged with doing site clearing work and erecting like a temporary access road and also temporary trailers for the construction crew essentially. So they did all that, or at least a portion of it, submitted an invoice to Steward, which in and of itself is weird because really MPW is the owner and the developer of the real estate, should be managing the process. So that's a big red flag in and of itself. But essentially, Steward didn't pay that nominal amount for that work performed. Accrued a payable, and conversely, the vendor accrued a receivable for 30, 60, 90 days. And then, with the county clerk, submitted what's called a mechanics lien or a claim of cash flow to get, a legal claim of cash flow to get them paid from Steward. So that's conceptually what's going on. It basically just means Steward didn't pay its bills. I don't know, Trend, if you want to add anything to that, but like just so everyone understands it, that's conceptually what happened.
Yeah, and in case of liens, what can happen is the person who basically is supposed to get the money, in this case, the service provider, can actually start foreclosures, and the
Yes.
rules for that are different in different states and different jurisdictions. So just keep in mind that any property having these kind of liens are not easily marketable if somebody wants to immediately sell them, because the buyers are going to ask for either resolution of this dispute or payoff, or just make sure that if there's a list pendants in the court, which is an initial action for foreclosure or non-performance, then that is resolved as well.
Yeah, and one more thing, just dovetailing on Mike's point from earlier, if you think about this, right? So we're talking about $160 million development. MPW, which should be the developer and the manager of the project, conveyed those responsibilities to their tenant, and then sent the tenant, literally transferred the tenant $50 million of the 160, lists it as costs incurred, right, on their own disclosure, at MPW's own disclosure. No work has been performed. And then the, Steward, as the purported, project manager, with that now $50 million in its bank account, didn't pay its bills. So the question becomes, what did you do with that $50 million? And I think I haven't heard a good explanation about this yet. As a matter of fact, the explanations the company has given, MPW has given, don't make any sense whatsoever. The question is, where did that $50 million go? And again, we think Steward's insolvent. I think that probably went into a general pool of funds of overall liquidity support for the operator. So anyway, that would, like, to be clear, if that's correct, that would be problematic to say the least. Let's just put it that way. So anyway, that's it for me.
No, awesome. No, appreciate you jumping in there, Rob. It's always great to have you on, and always good to get your insights, especially on two very, what I would call very important topics inside of the REIT world. So really appreciate your time, buddy. Trent, thanks, bud, for joining in. I'm so glad you were able to make it. and welcome. It's been a minute. Gavin had to drop, but we got Trent Wizzo back on, and Mike T still up came back in as well. So thanks, Mike. Zach and Tom, you guys jumped in. I'm not sure if you had any questions for Mike Taylor or just the panel itself.
Well, I think
I'm happy to do that.
I'm sorry. What Reet Rob I think was implying is that what Steward has done, I believe, by the court's view, if it ever does, it's theft. You're basically stealing that money. The intent is to build a hospital, but you're stealing it and using it for operations. And because the collateral, when you do those loans, the collateral ends up being that hospital that you built, and now there's no collateral, and it doesn't exist. You've taken that money and used it for yourself, or used it for operations, and so that's like theft. And that's why I think that Steward has not filed their financials, because they don't know how to fix this. And the CFO's looking at it and saying, well, if I fudge this and put those documents out, I could go to jail. So screw that. We've already made a ton of money. And then the alternative is, if we do put it out and it's clean, everyone's going to realize, and every bank's going to realize, we basically took that money and spent it. So now we can never get a loan. So I believe that once we get around to December 15, and I believe that there is a drop dead on the grace period ends on the 15th. Is it the 15th?
Yeah, so that's the end of what they called a quote unquote 75-day interim extension. But really what it was, in my view, it was like, look, the banks had a choice to make on the 29th of September.
Yeah.
They could either, send a default notice, or, give an extra couple months essentially to resolve things, after which they'll demand and collect collateral. So now we're kind of up against it.
Yeah. And so that's the situation. It becomes, very difficult. Just very, very difficult, because we've seen this before where the banks will just, oh man, I don't want to take this mark. So they just extend and pretend and extend and pretend. But the vast majority of these banks right now are not in troubled water. And so they can take a loss and realize it. And I believe that's highly likely what's going to happen this month.
Yeah, and Mike, I don't know if this was brought up yet, but what's also interesting, I think there's clearly kind of a standoff going on here too, because KPMG, Steward's auditor, has not provided the type of audit that Steward would like, or has not, signed off on the audit period stop. So like, there's a scenario here where Steward doesn't even have financial information to provide, because KPMG hasn't, completed last year's audit yet, which is incredible if you think about that.
The answer to that, it's impossible.
It's impossible.
Meaning that
Right.
they haven't completed the audit because the CFO hasn't given them the information, because they don't want them to find out that we have a going concern issue, and there's been impropriety in how we've allocated funds.
Yeah, and by the way, like, just for everyone to know here, everyone, including Mike T speaking now, everyone that I've talked to who either explicitly worked past tense in the audit business or is a current auditor, has said to me, like, the explanation being provided by MPW's management doesn't make any sense. And I wrote about this yesterday. It's indicative of very, very, very serious issues here. Like, I can't stress that enough. I've heard that uniformly across the checks that I've performed, just for everyone to know.
And of course, Rob, the reason why that MPW isn't at 2 is because of the passive money that's in the REIT space, and they just don't know and don't care. It's smart beta. If
you're gonna find out,
allocating to blah blah blah. I mean, this is the same thing. Why did it take an additional 3 quarters for everyone to figure out that Carvana is a goose egg? It's because of that passive money. It doesn't they don't actually figure it out until the absolute 11th hour, and here we are. And so, like, for me, I'm seeing this over and over and over now, where these companies that have a destiny with Dr. Zero are not going there when all the evidence is sitting, burning a hole in your face. And I believe it is the
It's a good way of putting it.
It is the passive money that just doesn't know and doesn't care until the 11th hour, which is like an unbelievable setup for making an incredible amount of money. I've been debating, and maybe you guys will tell me, because a number of people come out to me and they don't believe my returns that I've done in a hedged book over the past 3 years. And I was thinking seriously about putting out my monthly returns for the past 3 years. And then they still won't believe it. But I've been debating with my son on doing that, or how to do it, because there's been so much money to be made because of instances like this, and very few guys have the staying power to actually make the money. I don't know.
So, real quick question for Rob, Rob, that what could be the rabbit that they could pull out this time on December 15 in order to just keep this story chugging along?
Yeah, I think what's probably going to happen here. So, like, if you game this out, and there's a ton of game theory here, ultimately this is going to result, at best, in my opinion, in a rent cut at Steward. And I'm not talking about like a 10 or 15% rent cut. I'm talking about like a 60 to 65% rent cut to make things sustainable and allow Steward to cash flow, assuming it just doesn't go away itself. Which, you know, we can debate that, and I guess we'll find out. But I think what's going to happen here is, because MPW is like pushed this so far down the road of like impropriety, that they kind of like, they have no choice but to continue to lend into Steward to keep it going. The problem for them now is that they're like, whereas previously there were no eyes on, there are lots of eyes on, and they've lost their cost of capital. So like the prior model was, we go out and we do a secondary, and then we kick these loans over to our operators to fund ourselves. Well, like if what's interesting here is if they try to sell stock now, stock goes to 5 and the short still works. If they lend against, or they borrow on the revolver, they take leverage up and everyone sees it, people are going to puke the stock, the short still works. So like, it's a really, really interesting setup, because they lost their cost of capital, and there are tons of people paying attention to this now. And I think they have no choice but to lend if they don't want to like go to 2, to Mike's point, like next week. You know what I mean? Like, I don't know. That's how I think about it. I don't know if Mike or you have a different view, but it's a really bad setup.
Well,
like,
I look at
really
it like
bad.
this, though. Think about it like this: is that okay? So they go draw on the revolver and they make a loan to a company that's insolvent and will not provide financials. And first of all, I'm not sure how the board could allow that, but let's assume they own the board, and so they can do whatever the hell they want. Like, to what end do they do that? Meaning it's over. It's already over, right?
Yes, I agree.
They've already,
it's just a question of how and
but
when.
they've already gutted the company, right, for all that money that they paid themselves. So, so honestly, right, at this point, if they extend and pretend, it doesn't actually help them, right? Because it just you know,
makes the prison sentence longer.
Exactly. So
yeah, like I hate to say it, but it's true.
You know,
like,
why not call it the monkey is dead, the show is over, and we get to just do this nasty workout and start over, wipe out the debt holders, wipe out the equity holders, or, you know, the debt holders, which largely is them, right, are going to have to do some sort of workout. The REIT goes bye-bye, and then they start it back up again. And then, you know, 2 years later, you know, float the REIT.
Well, you know, it's funny, Mike, there's been an interesting narrative shift underneath the surface. So, like, we came out of the gates storming in April saying to clients, like, look, you have this Frankenstein monster that isn't really a REIT, because effectively what they're doing is they're investing in the OpCos along with the real estate, right? Like, they're taking this PropCo-OpCo arbitrage and effectively smashing it back together and trying to, like, convince people, like, we're a REIT. Well, since then, they've changed the narrative, and I'm talking about MPW here, into we invest in holdcos. So, like, I personally think that there's some element of, like, rebranding there into more of, like, a lender or like a development bank type model, where they finance like the entire opco plus the real estate in whatever form this entity takes after the workout, to your point.
Well, the problem is on that workout, they become the owners of the
Yeah.
hospital, not just the property.
Yep.
Right.
That's
And
right.
then,
And it's a zero.
And you know what happens then? Then you're not.
Yeah.
Then you're not a REIT.
You're not a REIT.
That's the problem.
Well, and also in addition to that, like MPW itself, it's very highly levered. It's levered about 8.5 or 9 times cash EBITDA. It's trading in the mid-teens on an EBITDA multiple if you use that metric. The problem for them, hospital systems, as you know, are valued at like 6 to 8. So if they have to, like, if in a scenario where they take the keys of Steward, a big chunk of their enterprise immediately receives a valuation multiple in the market that's half their current value, and so their equity value smashes down like almost instantaneously.
I mean, you got it. And that's why I'm like, why would they extend to pretend now? Because what are you going to get? Another 4 months or something? I don't know.
Yeah.
And then, believe me, like, Steward's still not going to file the financials, right?
No, they won't.
Right.
They
and
won't.
So to what end are you doing this? I mean, maybe they need to buy time to properly pick out their beachfront property in Belize. And by the way, they got to get quick on that because it's starting to get crowded, Belize beachfront property, So, you got Sam and his girlfriend and all these other crypto bros, right? So.
Yeah. Well, anyway, guys, listen, I got to jump because I actually got to take care of the day job. But Rob, thanks a lot, man. I'll catch you later, right? And Mike, be well.
Buddy.
Thank you.
All right, guys. See you later.
So we got time. We got time for probably 1 or 2 questions, and then I'm gonna have to call it a day here. So Zach, I know you've been on here for a minute, and Tommy came on as well. But Zach, why don't we start with you? If you got any questions, and Mike T, I love it's. I can every so often I can hear the low rumble of that.
He's whipping by. He's whipping by.
And it's absolutely brilliant. It's absolutely brilliant. I love it. But Zach, welcome, my friend.
Yeah, no, Rob.
I was good to have you back.
My questions around Mpw and really appreciate all his work on there. But I'm just curious if Mike had any takes and what's the next shoe to drop there, or just FTX miss? Is it Silvergate, or what does he think there?
Oh, Silvergate. Oh, my God. I like the new one. Hey, we're going to sell our deposits, which are really probably money laundering deposits. And what bank needs more deposits right now? It doesn't even make any sense. Like, you're going to get a high dollar for that. I don't know. I mean, look, the best thing that FTX has going for it is that they paid off this White House. And that's probably why this is really slow going. Under normal circumstances, the DOJ, FBI, everybody would be on top of this because it looks like that this fella did steal probably $8 billion of crypto and, for that matter, dollars. And it appears that SI kind of is in the middle of this whole thing and has tons of red flags on who they were dealing with. And everybody's looking the other way, probably because all the right people were paid and nobody wants to give their money back. I mean, think about it. This guy is a freaking fraud. And the first thing that should happen is that Democrat Party would be like, okay, we're putting our money back here. Our money's all going back. They don't want to do it. They don't want to do it. And that's why this thing is just being kind of put on ice. So the wheels of justice are slow. But for instance, Charles Ponzi, I don't believe, was actually arrested for his original Ponzi scheme for 7 years after it blew up. So even then, the wheels of justice were slow. I don't think it'll be 7 years. I think it's going to be much shorter than that. And I also think that there's an extremely high probability that our good friend Sam Bankman will die of natural causes in the relatively short term, which would resolve a lot of problems.
Mike Taylor, you always come in with some great one-liners. All right, so Tom says you got a hop. So Julian, you get the final question of the afternoon, my man.
Thanks, guys. Mike Taylor, very much appreciate you making so much of your time available to everybody. I'll just get to it really quick. You've been so good on your calls with stuff going to zero. I was just wondering if you would be willing to give some other names that you think are worth taking a look at that are in that silo.
Well, if you watch the last one of the last Hedgeye things, and if you looked over my shoulder at my whiteboard, a whole bunch of them were listed on it, and they're on their way.
I got those. That's perfect. All right.
One
Thank
thing
you.
I'll tell you one thing that I'm looking at that I'm really worried about. Cruise lines. They've basically diluted themselves to hell. They have an unbelievable amount of debt, and if the Fed doesn't pivot in the front half of this year, I think once these consumers have to start paying their student loans, I think cruise lines uniformly are in trouble, terrible trouble. So I'm not sure they make it. I'm not sure the equity's worth anything. And I mean, a lot of the shorts that I have, I've talked about that I'm very familiar with. I mean, you guys know that I've been bearishly positioned Tesla quite a bit. I still am. And this is really interesting what's happened to Tesla right now as a stock, because you're like, wait, things aren't that bad. Why is it going down every day? And something has happened. This is really big money that's exiting. This is not just retail. Something has happened. Maybe it's political. There's a lot of things that are going on that I can't talk about in a public forum about some very large hedge funds that may have been incredibly aligned with the Shanghai gang in China. And now that Shanghai gang is dead, gone, all of them gone. And so maybe, for instance, the leader of those very long-lived large hedge funds have stepped down because the writing is on the wall. There's a gigantic problem coming. Those are things that I can't talk about in a public forum. But you can read between the lines and understand who I'm talking about and what without talking about it. But
100%,
yeah,
100%,
and
yeah.
So there's an awful lot of things like that are happening. And I mean, I'll just wrap it up. You know, a friend of mine. Look, I'm bullish right now into the CPI. All right, and I hate it. I hate it because every bone in my body says everything's gonna blow the hell up. Yuck, awful, terrible. But I'm long. I'm that long into this CPI thing, because if I think about it, like, what would be the most painful thing that could happen? And I'm like, oh, we get another nasty squeeze and kind of like a illiquid Santa Claus rally, and then blow up in January, and that's kind of like how I think it's going to play out. But take a step back. We got these student loans that are coming. We got the low quality credit people, you know, with FICO scores sub 650, are like maxed out in cards now. Everybody is cutting capacity, cutting staff, hiring freeze, and these are tech companies all the way down to contracting companies and that are working the housing market. We're going to see all of this hit in the front half, if not January, very quickly. And then you have the student loans coming back on. You have an inverted yield curve. You have a government that is going to have difficulty funding itself because it's too expensive on the short end. And lastly, you have $90 billion a month of quantitative tightening. And so I'd look at that and say, how is anyone long that? And here I am long it. So I'm just playing cute because I think, I don't know, maybe I should take it all off now.
No, I mean 10 minus 2's at negative 0.84, right? And yeah, it's a big number. I mean, it's the lowest it's been since 1981. Last time we saw yield curves this inverted, so it's pretty pretty intense stuff. That's for sure.
I'm terribly concerned that we are going to have, a real whack job on the economy, and it hurts regular people, and that's what I'm upset about it. Most people don't make money in that environment. Most people get carried out. They lose their home. They got to take their kids out of private school. Really difficult life choices, and I don't know. I feel for them. I feel for them. So, and I'm in that sad phase now, where I kind of see what's coming, and I'm like, oh God, I feel so awful. So, not that I won't make money on it, but I still can feel awful and make money.
That's the one rule, right? Is make money. But Taylor, it's always a pleasure, buddy. I'm so grateful. Thanks for giving us your time this afternoon while you're down in Miami at the Speedway. Hopefully, you down there the rest of the week or just a couple days?
Yeah, it's a whole week. We're doing Homestead, and then
nice.
we're driving up. We're going up to Sebring, so that
cool.
so that he can, because we're going to be racing that in the spring, and so he has to learn all these tracks and go around in circles. And I got to go over and see how he's doing, because this is the first time he's with the whole team, and I want to see. He's the newest guy, the first guy out there. I want to see how close he is on the pace.
Awesome.
And so we'll see. But yeah, stay tuned. We'll have a lot of stuff going on.
Yeah, I can't wait. That's awesome. Good for Max, and again, appreciate it, buddy, and for all of you guys, and for everybody listening in, appreciate your time this afternoon. I see my colleague Freebird out there. He wanted me to remind you that XLC is returned to its dumpster fire ways, and so yeah, pretty much everything comms is garbage, but except for T-Mobile. But anyway. Appreciate everyone. We'll be back next week. We won't be on Wednesday. We're actually going to be on Thursday afternoon at 2 p.m. So it'll be Thursday at 2. We've got an internal company meeting happening on Wednesday. So it's just pushed today. So we'll be back on the weekly notebook review next Thursday at 2 p.m. And then we've got a beginner's guide on Friday. So I'm going to be powering through that. Hopefully I'll feel even a bit better, even better than I do today, which this took a lot of energy out of me, though, boys and girls. So I'm going to go have a cup of tea and go sit on my couch for a minute. So I appreciate you all. You guys are rock stars, and thank you everybody for chiming in. Jimmy, Gavin, Trent.
Appreciate
Mike.
you, Robert.
Yeah, man.
Can I throw a quick plug in there? We almost
eclipsed.
Yeah. We almost eclipsed, but we didn't beat the other Twitter space that says Tesla's going to triple in 2022. There's 600 people in there, so the bottom's not in yet, guys.
Tesla's going to triple? Is that what it said?
There's still, a couple days left.
Oh, man, that's awesome. Well, I'm glad that we have 600 people that are willing to, think about things a little bit differently and act differently. So just remember, fade those feelings as I alluded to, and execute. That's why we put in all those long hours. But all the best, everyone. We'll talk soon, and I'll see you guys next week, if not sooner. Cheers.